Stocks in the U.S. are surging and setting record highs, but what else is new? Well, Chinese stocks are surging. And that's a whole other thing, which is what we're going to focus on here. Welcome. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And of course, it only took but a few days for the levitation to resume on Wall Street, but the much bigger story is an absolutely historic jump in China. We've seen over the past several really years here, Chinese stocks aggressively underperform. As a matter of fact, they were down close to 30%, 30, as if that weren't scary enough, last year, whereas the S&P was up 16, global shares were up 10, Europe, for all its issues, was up 2% almost last year, and emerging markets, excluding China, were up almost 8.5%. But China just absolutely blistering losses until this week. We're looking at this point, a move that is the largest weekly rally in over a year, close to 16 months, and also a pickup in activity. The Financial Times estimated that we are at a 5-month high in turnover on Chinese markets as of Wednesday this week. And so the question, of course, that we have to ask ourselves when we see such emphatic performance is, why is it happening? What's behind it? And is it time to buy? Is it finally now the opportunity, after such vast period of underperformance, to buy Chinese stock markets? So that's what we'll concern ourselves with here. We'll take it apart and look at how incoming CPI data do with us just over the coming hours here, evening time in the U.S., morning time in China, how that's going to perhaps inform this story. So first, here's the ASHR. This is the catch-all ETF tracking China's CSI 300 index. That's a kind of S&P 500 for China. It is the catch-all that grabs all of the key names in the Shanghai Exchange and the Shenzhen Exchange, the two big exchanges in China, and so is basically the broad-based benchmark. And what we can see here, this is a weekly chart. On the bottom is the rate of change, 1 week rate of change. And so what we see here is obviously a dramatic surge. It doesn't look as dramatic when we look at the price action, but when we look at the percent change, this is a blistering rise. And the last time we saw anything like it was back here. So what we're looking at is really a rally to behold. Now, the question, of course, is why is it occurring? And it's not exactly a happy story of a rosy economy finding reflection in asset markets. No, on the other hand, it is the expectation that finally Beijing has decided that a falling stock market is counter to its interests and has begun what appears to be a serious firefighting campaign. Earlier this week, we heard that Central Huijin, which is an investment unit of China Investment Corp, China's sovereign wealth fund, that it's going to start to significantly expand purchases of local ETFs. In other words, the government is moving to buy Chinese stocks to prop them up. At the same time, we heard that the China Securities Regulatory Commission chair Yi Huiman has been removed from his post. And this is somebody that's very much a grandee within China's Communist Party. So there is a certain sense here, like the recent weakness is being hung around his neck. He is being made into a sort of scapegoat, or perhaps more benignly, there is a sort of changing of the guard being signaled, or a sort of regime transition. And so with that, we have a situation where the markets have seemingly concluded, look, authorities in Beijing have decided that they now want higher stocks. They're prepared to put their money where their mouth is. And so markets have surged. Okay, fair enough. But does that say anything good about the economy? Is that in fact a reason that stocks should keep going up? One argument one could make, certainly, that is that with the recent banning of short selling in some areas of the market, with these efforts now to just outright buy shares by government directed entities, that what's going on is a confidence building exercise. And that if Beijing officials were to restore confidence in Chinese markets, not only would there be buying locally, which really is a pittance, but especially at the retail level, but you might attract foreign capital back. Foreign investors have been leery of China now for quite a while, especially since the COVID period. And so maybe what you do in stabilizing these markets is you attract foreign capital. That foreign capital gives a boost to liquidity conditions, gives a boost to the overall economy, and then maybe that's your vehicle to get the kind of capital back through the door in order to get actual real economic outcomes to start looking better. It's an interesting gambit, to be sure. And then there is the economic data that we're looking at today, which suggests that if such a gambit is going to be effective, then it's got a tall bar to clear. The expectation is that CPI is going to push deeper into deflation territory, down 0.5% year on year. Not a whole lot of change for the PPI component. It's seen down 2.6% year on year. But perhaps most critically, both are seen holding in deflationary territory. And for CPI, really the hope and prayer for China's rebound, the idea that domestic demand can be a vehicle to power this economy forward, even as the external sector struggles, and we'll touch on that and why that's such a big deal in just a moment, that here things are still anemic. The price of things doesn't generally go down if there's demand. If people want to be buying things, they compete on price, which means that if I want to buy something and somebody else wants to buy something and somebody else wants to buy that same thing, we will bid up the price of that thing, and prices will go up. The problem here is that it suggests prices are going down. So that means I don't want to buy anything and somebody else doesn't want to buy anything and neither does anybody else. You put things on discount to stoke demand because that demand isn't there. So that we are seeing deepening deflation would suggest that indeed demand is still absent. The consumer is still brutally scarred and the economy is still in trouble. Now, one counter argument to that interpretation of the situation has been that really the disinflation and deflation outright that we've been seeing in China really has more to do with global dynamics than it does with what's going on in China, and that really most of this is falling food prices. And there is some logic here, to be sure. If we look at the components of Chinese CPI, we can see over the past 3 months, food is overwhelmingly the negative catalyst. In October, down 4%. In November, down 4.2%. In December, down 3.7%. So clearly, this is a major, major headwind. Same thing for energy. If we look at the transportation and communication component that subsumes energy, we can see that's a huge downdraft. And of course, global prices for food and energy are not set in China. They're set on global markets. And we have seen that they have been both very elevated and falling over recent months when we look at the inflation structure in Europe, in Japan. So this is certainly a global phenomenon, not necessarily one that's domestic to China. And of course, if we look at this estimate of the Chinese CPI basket broken down by component shares, we can see food is a huge part of this at essentially a fifth of the total. And if we look at transport and communication, that's another 14.5%, and energy falls in there. So needless to say, there's some logic to this argument that, in fact, the economy isn't perhaps quite as terrible as the argument goes, because once you strip all of those things out of CPI, it isn't negative, and those are global forces, not China-made forces in isolation. Well, sort of. Here is Chinese core inflation. This is excluding food and energy. And what we find here is that indeed it is north of zero. That's encouraging. But also that this trend has not meaningfully improved whatsoever since China reopened from COVID restrictions in late 2022 going into 2023. In fact, core CPI is drifting dramatically lower and is barely above zero, 0.6% for the past 3 months. Now, that's not negative, but it is very weak, and the trend, really since the middle of 2021, has pointed unmistakably lower. So the idea that food and energy are amplifying what is otherwise not negative CPI and pulling it into negative territory, that seems to hold. But the idea that that's a game changer in terms of the trend for pricing power in this weak economy, that doesn't really hold up. And then, of course, there's the idea that this is localized. This is food, this is energy. This is not everything else. But if we look at GDP data, it also tells a different story. China is, for the past 3 quarters, in a kind of strange space where nominal GDP growth is actually lower than real GDP growth. And that's not how that's supposed to work. What is nominal GDP? It's just the sum of total output of the economy, the value of all the goods and services produced. Now, some of that value is inflation. So real GDP is the value minus inflation. Well, what do we see here? We see real GDP above nominal. So nominal minus inflation is real, and real is bigger than nominal, which means that what we're doing is we're subtracting a negative number from nominal GDP. And the story here is dramatic. We're looking at a deflationary gap here of 1.5%, 1.6% over the past 3 quarters. So CPI shading this way or that way by energy and food, while valid, certainly does not suggest that the economy is not suffering from essentially a total absence of demand. Because looking at GDP numbers, the gap is vast. 1.5% in terms of deflationary implied disconnect. And that's 1.5% of the world's second largest economy. So the gap here is tremendous. And the absence of demand, very much an economy-wide headwind for the economy. Now, next comes the question, of course, well, why would this firefighting for the stock market's appearance be anything that changes this story? And the answer is, well, it probably can't. And that's because the story largely links back to what's been going on really through the COVID period and thereafter. What we see here on the bottom is the growth rate in Chinese exports and imports year on year. You can see they are just barely climbing out of negative territory where they've been stuck for a good part of last year. In fact, most of last year. And that the trend really going back since mid-2021 has been toward decline, both imports and exports. And that the overall Chinese trade balance has been narrowing for the better part of 2 years. And that's really the issue at its core. China is still the quintessential sort of middle of the global supply chain, the value add center. It was certainly much more of that in the pre-COVID period. But of course, it opted to stay in lockdowns well past the point that its major customers in the rich world, mainly the US, but of course also Western Europe, shook off COVID restrictions, started to reopen, started to see demand coming back, and couldn't rely on China as the value-add middle step du jour because China was still closed. As a matter of fact, the peaks in economic growth in the catch-up period after COVID, that blistering jump in European and US growth, as all of that stimulus came together with the introduction of vaccines and the removal of restrictions, and growth started to race higher to catch up from the losses of the lockdowns, they peaked by the middle of 2021. And since then, what we've had is a blistering rate hike cycle for both markets and a general moderation just because the catch-up has run its course. Not to mention that most of the stimulus has been spent. So when we look at that now, we find, well, if that peaked in 2021 and growth has since been slowing, first, those markets had to find new supply chains. Not only because, of course, we can see a firming consensus in Western markets around diversifying away from China because of Beijing's more combative, more geopolitically assertive stance in recent years, and the pandemic as a kind of way where everything was on lockdown, and so making those supply chain adjustments really couldn't have found a better time. But also because by the time China reopened, the peak in demand from its key markets was long past. The trade side is, of course, the engine of Chinese growth. It very much relies on being the abundant labor value add center, taking in intermediate and primary goods, so raw commodities and semi-finished things, applying that vast pool of labor that they have. And of course, the demographics of China mean that pool is now shrinking for 2 consecutive years now and at rapid speed. A whole other issue and a whole other talk for another day. But still a vast pool of people for now. That pool applied to commodities, applied to intermediate goods to finish them or to get them more finished and then ship them on elsewhere in the supply chain, that is overwhelmingly the way that China's economy has any growth at all. From there, you get employment. From that employment, you get consumption. From that consumption, you get investment in the housing market now falling apart because the buying has stopped, because employment has suffered, because the external demand isn't there. Hence the falling imports and exports in tandem. So goosing up stocks here really isn't the recipe to fix any of those things. All of those things continue. As a matter of fact, we just see today still more measures out of the U.S. to restrict Chinese participation or to limit it in U.S. markets. So the damage here is structural and the boost to stocks cosmetic. Now, looking at Citigroup's China Economic Surprise Index, we can see that recent data outcomes have started to slide relative to forecasts. You can see the index here now below zero, suggesting outcomes are tending to underperform relative to expectations. If we, on this basis, end up seeing a weaker CPI number, a weaker PPI number than expected, then this reality may well dawn on the markets. And although it certainly doesn't behoove investors to try to fight the quote-unquote national team in China, buying up all these stocks in what is a generally illiquid, easy-to-push-around market, there is some reflection of the underlying weakness of Chinese economy that is tradable, and that is the Australian dollar. China is Australia's largest trading partner, making Australia very exposed to China's business cycle. So what you see here is that the Australian dollar, heading into this data, has actually broken below this support line here, which has been a key level of resistance, then as support. We've clearly cracked it and have moved to retest and are holding, as if to say the break is valid. From here, we are likely to head lower. So what this gives us is a sort of tradable high against which to manage risk and perhaps room to retest toward the bottom of this area here near 63. So if one were to be looking for exposure to China weakness economically without trying to fight Beijing over where ASHR or FXI, the large cap ETF, are going, this might be a vehicle that one could look at, especially in an environment where the US dollar is inching higher as Fed rate cut expectations fall away. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what is likely to happen next. I'm back on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. See you tomorrow.